Started. Welcome everyone. Welcome everyone to Triangle Blockchain Development. And tonight we're having Eric Moore on. Just going to go over some updates and this SHLDQ situation and some sabotage information. And he has some very important, incredible information to share. He's going to get some records straight, get some facts straight. So without further ado, ladies and gentlemen, I present to you Eric Moore. Eric Moore, you go ahead and have the floor, sir.
All right. How's everybody doing? Everybody good?
All good.
Yes.
All good.
Good.
Great. Thank you.
Thank you.
Okay, good. Okay, what I'm going to do tonight, guys, I'm going to do something a little different. I'm going to actually walk you through why I'm so certain about Sears Holdings, because I know how crazy it is to be invested in a company that is in bankruptcy, and I know how absurd it sounds. And most of you have been with us for more than a year. Some of you 2 years, 3 years, 4 years, and 5 years. So I'm going to walk you through court documents without legalese and anything that has a strong, if it's some strong legal language that you don't understand. I'm going to make sure, if you take notes, make sure everybody has a pen and a piece of paper, because everything I'm going to show you, you can verify with Google without strong legal language. And this is being recorded, so you'll be able to rewatch it if you don't have your pen and paper ready. So I'm going to give you a few minutes about why about the situation. I'm going to start from the beginning. I'm only going to go about 2 or 3 minutes, and then I'm going to show you the proof of what I'm talking about. Okay? So Sears Holdings is a holding company, and a holding company is allowed to have multiple businesses, right? So a holding company generally does not own anything but other businesses. Under the tax codes, under all legal law in all 50 states, including overseas in Canada, Germany, Switzerland, you're able to have a holding company, and the holding company can have different businesses and different lenders. Everybody with me so far? So this is the equivalent of having 50 houses. You could have 10 mortgages on the first 10 houses and no mortgages on the other 40 houses. So then we're going to go with a house example to give everybody an understanding. Let's assume that the first 10 houses are in foreclosure. The last 40 houses have no mortgages, no liens, no debt. So we have 50 houses, 10 houses that are in foreclosure, no payments been made, they're 2-3 payments behind. You got 40 houses, no mortgages, no liens. So the holding company owns all 50 houses. We take those 50 houses, and the name of the holding company is Joe Blow Holding Company. When Joe Blow Holding Company files bankruptcy with all 50 houses, the mortgage companies for the first 10 houses show up in court, and they say, hey, you haven't been making the payments. We want to foreclose on the home, or we want you to show us proof that you can make the payments. The other 40 houses have no creditors. Is everybody with me so far? All right. So the 40 houses have no liens and no mortgages. So 90 days after the bankruptcy has proceeded, the debtor or the holding company says, Your Honor, I'd like to take these 40 houses and I'd like to transfer these 40 houses out of bankruptcy because they have no mortgages, no liens, no debt. And as everybody here knows, if you have a mortgage on house number 1, they can't go over to house number 39 and say, why don't you sell that home and make me pay for it? Because when you took out your mortgage, it was on 1234, Jackson Street. So that their security is that home. Okay. So you got 10 houses in foreclosure and 40 houses in bankruptcy with no liens, no debt. So the court allows you to take those 40 houses out of bankruptcy because no creditor can stop you because you don't have any creditors. Everybody's with me so far? Okay, so stay with me. I'm going to give you the exact same scenario, except we're just going to use a company. So we've got a company called Sears Holdings. Okay, we've got Sears and Kmart, which everybody knows about. Sears and Kmart had debt. The other companies that Sears Holdings had, Shop Your Way, Die Hard, Kenmore, Craftsman by Sears, 1,100 pieces of unencumbered real estate, 5,000 acres of land and mall parking lot space. Let me say that again, 1,100 pieces of unencumbered real estate, including over 5,000 acres of land. You can look this up, document 892 in the bankruptcy. Document 22 under unencumbered collateral. You'll see a list of 1,100 properties, no mortgages, no liens. Die Hard had no debt. Kenmore had no debt. Craftsman by Sears had no debt. Shop Your Way, the credit card and the rewards program, had no debt. Sears Home Services had no debt. Innovel Solutions, that does all major appliance delivery for Costco, Amazon, Home Depot, and Sears and Kmart, no debt. Service Live, the company that does more repairs on washers, dryers, dishwashers, than any installation of those large appliances, the number one company in America, no debt. So we have two businesses, Sears and Kmart, with debt, and we have 8 to 9 businesses, including the real estate, with no debt. So in February 2019, a company was created by our largest shareholder called Transform Holdco. He took this company and set it up as a corporation. He got permission from the court to take all the unencumbered businesses with no debt and move them out of the bankruptcy to a separate corporation that we own on a pro rata percent basis, right? He got permission from the court to liquidate the stores, some of which were losing money, a very small amount, and take that money and pay all creditors. Now, here's the kicker. The creditor for Sears and Kmart was our largest shareholder, Eddie Lampert. There are no other significant creditors other than the pension. And I'm going to go into the pension a little bit later. There are no other significant creditors. So Eddie Lampert was owed $2.6 billion secured by inventory. He sold all of the $2.6 billion in inventory, recovered the loan, ordered more inventory over the course of the last 2 years, and made a profit and put that money into Transform Holdco for us. So his debt has been paid for more than 2 years. So there's no debt owed from Sears Holdings to Eddie Lampert and ESL. So stay with me so far. We have two businesses that had debt that was secured by inventory in the stores and by real estate. That real estate was sold. It brought in $700 million. The inventory was sold. It brought in $2.6 billion. Instead of taking the cash, he took new stock in Sears and he put the cash into an account at Transform Holdco. So stay with me. Let's go back to the beginning. We got 50 houses, 10 houses with mortgages on them that have now been paid off or sold. We've got 40 free and clear houses, no mortgages, no liens. No creditors can show up in a bankruptcy unless they loaned you money. So here's where we are. And I'm going to start giving you document numbers so you can check this information. So the particular assets and businesses that were unencumbered gave a loan to Transform Holdco for $350 million in order for that business to have some funding when they exited bankruptcy. We filed bankruptcy on October 15, 2018, and all of the unencumbered businesses that we, the shareholders, own left bankruptcy in February 2019. Okay? So those businesses were earning, according to court records, not Eric's speculation, not Eric's projections, not numbers I made up off the top of my head, according to court documents available to everybody on this call, everybody on Seeking Alpha, and everybody on Reddit. More than $1 billion a year profit, all documented in the court record. All right. So I'm going to start showing you guys a few of the documents. You can look them up yourself. And I'm going to show you a conversation between the judge in the case in February 2019, explaining the loan of $350 million secured by the unencumbered businesses that were appraised at a minimum of $3.9 billion. So I want you to stay with me and keep in mind, this is the court record. This is the judge asking about the unencumbered assets. Now, keep in mind, if you go online, nobody is discussing unencumbered assets. All they're talking about is all of this so-called debt, the fact that you're going to lose your money, the fact that you're going to get wiped out, so on and so forth. But I'm going to show you the actual court record. So I'm going to pull that up real quick right now and share my screen. And I'm going to read you what the judge is saying about these unencumbered assets. And I'm going to show you those unencumbered assets in February 2019. And I'm going to show you that they passed straight through the bankruptcy because there are no creditors to unencumbered assets. Everybody understands that you can't file bankruptcy. And if you don't have a lien on that asset, you have no claim to that asset, even though you're still in the bankruptcy with the other person. Because if you don't have a loan backed by that collateral, you have to rely on your particular collateral. So let me pull my screen up for a second, and I'm going to show you the actual court record. Let me see, can I get it? Okay, we're already showing my screen. Hold on, guys. Give me a second. We're going to pull the document from the court record. And you can all pull these documents yourself. I know a lot of you are online, but the key thing is making sure that you're focusing on the right thing. All right, this is document 2886, page 104. Everybody see the date, February 11, 2019. I'm blowing it up. Okay, everybody can see that?
Yes.
Okay, page 104. I want everybody to pull this document. And I don't want you to waste your time on Seeking Alpha. Don't waste your time on Reddit. I'm going to give you all the facts so you can look at the facts and not the nonsense being talked about online. Okay, this is a conversation with the judge and the lawyer for Sears confirming the value of the unencumbered assets, no debt attached. Stay with me. Let me pull it to the side. Here we go. Can everybody see that clear? You see it's the same document.
Yes.
Okay, no Photoshop, no nothing. Okay, here we go. The court, is there a value here in the unencumbered assets on a reasonable basis in excess of either 3.9 billion or 3.5 billion, depending upon how you count the rollover of the junior dip? I think there is, Your Honor. If Your Honor would go to slide 3, and what I'll try to do here is walk you through the numbers. So he's going to show the judge the proof of this over 3.9 billion. Stay with me, guys. We have a bankrupt company that everybody says has no money. Am I correct or am I wrong? I'm correct, right? Everybody online says the company is broke. They don't have any money. They're going to zero. There's too much debt. Right here, the judge is confirming that the assets are worth over 3.9 billion and they are unencumbered, depending upon how we count the junior dip. So let's see how much the junior dip loan is, because that loan didn't exist until 1 month after bankruptcy. A dip is a debtor in possession loan. Okay, so let's see how much the loan is securing these assets. Let me pull that document up really quickly. And then we're going to do the math. And if you expect people online to do this, you're sadly mistaken. And I want to keep talking about the people online for a second, because I know a lot of you are relying on nonsense from anonymous people. And I'm going to give you the facts of what's going on. So let's see how much the junior dip loan was. All right, let's pull up the pro forma. Can everybody see that?
Yes.
Yeah.
All right, let me blow this up for you. All right, let's see the document number. Everything I'm showing you, you can pull these documents yourself. This is not Photoshop. This is not something I created. This is a document produced by the lawyers for Sears Holdings. Document 2355-1, page 621. All this is in my articles online already. Let's just look up the junior dip. The junior dip loan, it says rolled junior dip, 350 million. Can everybody see that?
Yeah.
All right. Roll junior dip, 350. How much money, how much collateral is back in this loan? Can somebody answer that for me?
3.9.
Okay, there you go. So we've got 3.9 billion securing a loan of $350 million, right? Does that sound like it's under secured? No, 3.9 billion minimum, and the loan is only 350 million. All right. So let's track this junior dip. All right. Now we're going to go to let me pull the document. Let me show you the document confirming the unencumbered collateral again. Here's another document. Document 892, like I said, unencumbered collateral. You can pull this up yourself, page 54 of 125. When you go to page 55, you see the second part, and it basically tells you that anything that is not secured by inventory is unencumbered, okay? You can pull this document, and when you go to the next page, you're going to see 1,100 pieces of real estate, commercial, in California, New York, Miami, all the major cities, unencumbered, over 5,000 acres of land, no mortgages, no lien. Okay? I want to make sure everybody sees this so they can pull these documents if they want. Doc 892, page 54. Okay? So that is what the junior dip is secured by. So let's see what happened to the junior dip in the asset purchase. So let's find the asset purchase agreement. It's document 1730. I'm going to show you what happened to the junior dip. Let me find it. It is right. Hold on. I had it in here. Right here. This is document 1730. I think it's page 6 or 7. This is the asset purchase agreement between ESL and Transform and Sears Holdings. It says rollover of senior debt. I need everybody to make a note that this is senior debt, because that's very important. Senior debt. The asset purchase agreement contemplates a rollover of 621 million of the senior indebtedness, including 350 million of the amounts owed under the junior dip term loan and approximately 271 million of the city LC facility into exit facilities. An exit facility is a loan that you use to exit bankruptcy. Stay with me. Did anybody see any creditors listed in there? No. So once this 350 million is paid off, we have the balance of those assets that are earning 1 billion a year with no debt. Okay? This was February 2019. If a company earns $1 million a year, no debt for 2 years, because that's been February 2020, February 2021, and February 2022. Would that be 3 billion? That'd be 3 billion, right? In earnings. All right. Yeah. I have not discussed any retail stores. I'm not talking about Sears or Kmart. I'm talking about the other businesses with no debt. I've already proven that you can't use this money and take care of any retail debt from Sears and Kmart. The businesses were separated 5 to 6 years before the bankruptcy. Okay. So now I'm going to show you the payment schedule right here. So this is document 892. The asset purchase agreement is the reorganization plan. There are two plans in a tax reorganization in bankruptcy. There is a Chapter 11 liquidation plan, and there is a reorganization plan. The Chapter 11 plan liquidates the assets you're not keeping. It liquidates the stores. It takes the money and pays the balance to the creditors. Now, there is an agreement with the company that came out of bankruptcy that any debt left over will be paid by that company. That's how it works. So stay with me. This is the payment schedule. Let me show you the document number. You can pull this up yourself. Document 892, page 20. This is a reorganization plan. All reorganization plans show you the order or priority of payment. Any document that does not have a payment priority may not be a reorganization plan. The carve-out is for the admin fees. Keep in mind, does everybody see where it says unencumbered collateral right there? Pre-petition, yes. Unencumbered. Okay. All right. So the carve out are the admin fees that they say we don't have the money to pay. So we've got 3.9 billion in assets. That's why the lawyers are still working. So if they're owed 70 or 80 million, 3.9 billion can easily take care of that. Would everybody agree? Okay.
Yeah.
So
Yes.
here go the all right. So here go the senior permitted liens. The DIP ABL liens was the first lien on the inventory. That inventory has been sold long 3 years ago, and it was paid off. So that debt is gone. You see the one at the top? That debt has been paid. Pre-petition ABL adequate protection liens, paid. 2018 follow adequate protection liens, paid. I'm going to show you the document where all these debts have been paid. Pre-petition LC facility adequate protection, paid. Pre-petition facility adequate protection liens, already paid. Second lien adequate protection, already paid. Junior DIP, how much was the loan, guys? 350 million, correct? We got 3.9 billion in assets. These other liens were secured by inventory worth more than their debt. So these debts were already paid when the transfer happened. So the only thing left was the 350 million secured by the 3.9 billion that was earning 1 billion a year. So the junior DIP lien was paid off immediately. So we took all those assets, moved over, and the debt was paid off except for the inventory from the 425 stores. So there is no debt left to be paid except the pension. And I'm going to show you what happened to the pension in a second. If you see this article from Wyco Researcher, it says Sears files reorganization plan, shareholders get nothing. Okay? They did not file a reorganization plan on April 18, 2019. They filed a liquidating plan. If you want to look this up, you go to the SEC document, you Google Sears Holdings, liquidating Chapter 11 plan, and it'll come up. A liquidating plan is not a reorganization plan. The reorganization plan is the asset purchase agreement in a tax reorganization. So let me prove that really quickly. I hope I'm not losing everybody. There are two plans. In a regular bankruptcy, there's one plan. In a tax reorganization, there are two plans. There's a liquidating plan and a reorganization plan. The reorganization plan tells us how we're getting paid. In a liquidating plan, it just liquidates the assets that we're getting rid of. So let me prove to you that that is the reorganization plan really quickly. I'm going to show you the sources. Here's a document filed by Sears lawyers. This is not my document, guys. This is document 2355-1, page 748. Again, it's document 2355-1, page 748. Let me read you what it says. To qualify for tax reorganization treatment, the sale of the assets and subsequent distribution to creditors and shareholders. Let me say that again. To qualify for tax reorganization treatment, the sale of the assets and subsequent distribution to creditors and shareholders. Did I just say creditors? No, I said creditors and shareholders of the sales proceeds must be pursuant to a single plan and arrangement for tax purposes. The sales agreement would constitute such plan. Can everybody see that?
Yeah.
The sales agreement should constitute such plan, okay? And would provide and generally would require that the liquidation of the seller corporation be completed from a tax perspective within a specific period of time, whether under a Chapter 11 plan or otherwise. Let me say it again. The sales agreement would constitute such plan. It did not say the Chapter 11 liquidation plan, did it? It said the sales agreement. The sales agreement is document 1730. Let me give you another source. Let's go ahead and see what the law professor had to say about that. All right, let's find it. All right, is that it? Let me see. Here it is. This is from the book Mergers and Acquisitions by Samuel Thompson Jr., a tax expert and tax law professor. And this is chapter 16, which is on Sears Holdings. So it's a merger and acquisition book, and the entire chapter is on Sears Holdings. And here's what it says. Also, as discussed, hold on, let me pull it up. Also, as discussed in chapter 9, the requirement that there be a plan of reorganization is generally met by the underlying acquisition agreement for the transaction. Did everybody see that?
Yes.
So
Yeah.
let me say it again. The requirement that there be a plan of reorganization is generally met by the underlying acquisition agreement for the transaction. Now, if you want to go to document 20507, I don't have it in front, I have it in front of me, but not on the screen. Document 20507, page 6, they say this is the plan of reorganization. Document 2507, page 6. So we got two Sears documents and the tax law professor. So I want everybody to stay with me. So now we've proven that those assets had no debt, correct? We're going to go back to this. We've proven, because we've got the word of the judge here, and we got the proof that that 3.9 billion is secured by only 350 million. Let's round it to 4 billion. We deduct 4 billion from 250 million. We get 3.75 billion with no debt to be paid. So we're going to discuss the pension for a second, really quickly. The pension settlement, I'm not sure if everybody knows. Let me stop sharing my screen for a second. The pension settlement was $800 million. I do not have the document in front of me, but you can Google it if you need to find it. So the only other debt we had, where it's about 100 million in legal fees and 800 million for the pension. So I'm going to read you something that Eddie Lampert said in March of 2006, and you can pull this up. You can Google Eddie Lampert 2006 chairman letter. Eddie Lampert 2006 chairman letter on pension liability. This is what he said. In Sears Holdings case, we expect a 1% increase in interest rates would reduce our plan's liability and funding shortfall by approximately 750 million. Let me say that again. We expect that a 1 percentage point increase in interest rates would reduce our plan's liability and funding shortfall by approximately 750 million. The pensions settlement is 800 million. Interest rates have increased almost 2 percentage points since this was written in 2006. So let me say the beginning part. The estimated pension liability of Sears Holdings or any other company. This is Eddie Lampert speaking in March of 2006. It's online under chairman letters. First, the estimated pension liability of Sears Holdings or of any company is very sensitive to interest rates. A pension is a promise to pay benefits in the future. To estimate in today's dollars what that promise represents, these projected future benefits are discounted back to today's dollars using current interest rates. The lower the interest rate, the higher the estimated pension liability. We said it again. The lower the interest rate, the higher the estimated pension liability. And with the interest rates currently near historic lows, the estimated pension liability for all companies is relatively high. If the interest rates rise in the future, however, estimated pension liabilities will decline. In Sears Holdings case, we expect that a 1 percentage point increase in interest rates would reduce our plan's liability and funding shortfall by approximately 750 million. Interest rates are up more than 2 percentage points since then. So the pension liability is not only funded, it would be legally considered overfunded. So the pension's 800 million does not have to be paid. So the only other debt left were the unsecured and the second lien bondholders. That's roughly $700 million. So let me talk to you about the cash that Transform has according to the court record. We've got the balance of the junior dip, right? And keep this in mind, guys. Innovel Solutions was one of those assets. It was sold to Costco for $1 billion. So somebody make a note of this. So that's $1 billion in cash, no debt to pay. Everybody with me? $1 billion in cash, no debt to pay. Die Hard was sold for $200 million. That's $200 million, no debt to pay. There was $1.3 billion that Eddie Lampert contributed to the company, and he converted it to equity. So he took his debt, sold the inventory, and put the $1.3 billion back into Transform. So that gives you another $1.3 billion. Then he borrowed, then they sold $700 million in real estate. And all this is documented on a one sheet I'm going to send everybody. They sold $700 million in real estate. Somebody keeping up with these numbers?
Yep.
Then we had another $570 million come in from Sears Home Services for 1 year. That's documented. That's document 2886, page 94. We sold $700 million in real estate. That's document 2352, page 45, paragraph 73. I'm going to say it again. $700 million came in from real estate sales. That's document 2352, page 45, paragraph 73. We had another $900 million as a tax credit, which comes to us in the form of a tax refund. That's document 20, page 4. So what I have given you guys is $4.65 billion in cash for a company that people think is broke. Go ahead, Howard. I'm going to go ahead and take your question now. Howard, go ahead. You got a quick question? I saw Howard had his hand up. Okay, I'll keep going. Okay, so we have a company. I got 1 more minute, then I'm going to take questions. We got a company with $4.65 billion in cash, according to court documents. I'm not counting the money that we're assuming is still coming in, because we only have about 20 stores, and we're not counting any revenue from the online business, and we're not counting any money from the 20 or 30 brick and mortar stores that we still have left. I have counted 0 to those numbers. And if you want to look up the document that shows that all this debt is paid off that I just went down, it's document 9788, page 23. It was filed on August 31st, 2021. And they told the judge, we paid off the real estate loan. We paid off the standalone LC facility. We paid off the ground lease term facility and the FILO loan. That's document 9788, page 23. So all the money left over from the junior dip, all the money we don't have to pay the pension now, all the money from the real estate that's already rented out, all of that money equates to roughly $7 to $9 billion, all documented in the court. If you divide $7 billion, and we'll take the low number, by roughly 50 million shares, what do we get? Somebody give me the number. What's 50 million divided by 7 billion? Somebody give me the number. What's 50 million divided by 7 billion? Anybody know? Anybody got it? 50 million by 7 billion. What will we have? I know if we
140.
140. Okay. According to the court records, before we pay off the 700 million in bonds, if we use cash, that would be the number we would get in value. That's according to the low estimates they gave the court. The 3.9 billion in unencumbered assets are actually valued at a lot more, but I'm only using the numbers that the court said was the minimum. So it's possible the payout is $100, but the actual value is $200, $300, or $400. I know at a minimum, from what I just told you, counting no income from all those other businesses, because remember, we don't have any debt. If you go to the website Transform Holdco, on March of 2020, Eddie Lampert announced that there was no debt at Transform Holdco. If our company has no debt prior to bankruptcy, they had no debt during bankruptcy except $350 million that we paid off, and we have no debt as of March 2020. Everything that came in after March 2020 is sitting at the company of which some of which will be paid out to us. So keep in mind, I have not talked about retail stores. I've not talked about Sears stores. I've not talked about Kmart. I've only talked about other businesses and assets that Sears owned that had no debt. The conversation online is not what you're hearing from me tonight. The conversation online is personal, lies, misinformation about me, and misinformation about what's actually happening in this case. And what I suggest everybody do is, if you don't have a source, if the person you're speaking to online, if you decide to waste your time, you need to ask them what happened to the unencumbered assets. And most people will say there are no unencumbered assets. Then you know you're dealing with a person that's a fool or somebody paid to mislead you and try to trick you into selling your stock. Because if they don't acknowledge what's in the court record, you're wasting your time. And everything I'm telling you, lots of those people online know this information exists. They are there to mislead you. They are there to get you to sell your stock, because if you don't sell your stock, they're going to lose money. And I won't bore you with how short selling works, but just keep that in mind. There are no creditors to Transform Holdco. We have had no debt. All this is documented. You go to March 2020 Transform Holdco press releases. It says we have no debt. We sold Die Hard for $200 million, Innovel Solutions for $1 billion. There's no debt to be paid. Right now, we are waiting not for the bankruptcy court. Let me say this again. The assets I just discussed are not in bankruptcy. I know that they left bankruptcy in February 2019. Our assets, our cash are not in bankruptcy. They are not subject to the bankruptcy court's jurisdiction. The only thing left in bankruptcy is a lawsuit that Sears filed against Seritage, Lands' End, and ESL. The lawsuit is requesting that Seritage, the stock symbol is SRG, and Lands' End, stock symbol LE, join back with Sears Holdings. If those companies come back together, the lawsuit is over. If Eddie Lampert buys Seritage or buys the rest of Lands' End, the lawsuit is over. Eddie Lampert owns 68% of Lands' End and over 30% of Seritage. If he buys either one of those companies or merges with either one of those companies, the lawsuit is over. We're in a mediation right now. They're not in a litigation. The mediation ended on June 30th, and they did not file an extension. So it's possible we already have a deal. If we don't have a deal, if we get no money from the lawsuit, it has nothing to do with what I just discussed. The lawsuit is extra money. Let me say that again. The lawsuit is extra money. We are not waiting on the lawsuit to decide or see if we're going to get paid. Our assets were unencumbered before the bankruptcy, only encumbered by $350 million during the bankruptcy, and they are now unencumbered again. So those assets belong to us. They don't belong to the pension because they're not owed any money. They don't belong to the first lien holders because he already got paid. They don't belong to Eddie Lampert because he already got paid. There's nobody left to pay but $700 million in unsecured bonds and us. And with $5 billion in cash, it's easy to pay $700 million. So the cash goes to us and the stock goes to us. We have to get at least 40% stock. That's how the IRS rules work. I'm going to show you one more slide and show you a source, and I'm going to take questions. So let me show you this slide really quickly. All right. I'm going to show you a slide. I'm going to show you where it's from. All right. Let's pull this up. Pull it right here. This is the book. It's called Corporate Taxation Through the Lens of Mergers and Acquisitions. It cost about $65. It's by Professor Samuel C. Thompson Jr. He's a Black law professor. He's an expert on tax law and tax reorganizations. Everybody can see that pretty clear. You can buy this book for $60. I did not create these documents. They come directly from this book. Here is what's going on. If everybody can see this chart here, If you look up document 1730 and you put in 368A1A reorganization, they're going to legally explain this chart. So they're going to legally discuss this chart. So document 1730 is in legal language. This is that document drawn out. Everybody clear? The legal language that's in document 1730, page 32, is drawn out right here. Okay, let me show you. Make it a little clearer. Everybody can see that, right?
Mm-hmm.
AC is the acquiring corporation. That's Transform Holdco. Everybody with me so far? Okay.
Yes.
The target corporation is Sears Holdings. All right. Old TC shareholders. When the dust settles, old acquiring corporation shareholders and old target shareholders. Acquiring corporation holds target's assets and liabilities. Did it say shareholders get wiped out? Anybody see that?
No.
Okay. It says under 354, target shareholders have tax-free treatment on receipt of the acquirer's common stock. And under 358, they take a substituted basis for the acquirer's stock. So we're getting into some legal stuff here. So I want to make sure you read this last line because everybody online is confused about what happens to the NOLs and tax credits. Let's see what the tax professor says. He says under 381, other tax attributes carry over to the acquirer. Did it say the tax credits go to zero? Did it say we're waiting on the IRS? No. Stay with me. I'm going to show you another one. Out of the same book. If we do this kind of reorganization, and this is the identical reorganization to what we're doing. This is a direct C, stock for asset reorganization. Same format, and this is what we did. See, the acquiring corporation is here. That's Transform Holdco. Assets and liabilities going to the right. And guess what we do over here, guys? We liquidate this company. Is that not what Sears Holdings is doing? They liquidated over here, correct? All right. Now, when the dust settles, the acquiring corporation holds the assets and liabilities. Does Transform Holdco have any debt, anybody? Did anybody answer that for me?
Zero.
No.
Okay. So we don't have any more liabilities, so we only have assets left. Right here, the target has tax-free treatment under 361. Anybody can Google tax code 361, and they'll show you what it is. If you Google tax code 354, so they take a substituted basis under 358, the acquirer stock is what they receive, okay? At the very bottom, let me pull this up. Also under 381, the acquirer carries over the target's other tax attributes. Doesn't say anything about shareholders getting wiped out, does it, guys?
Not at all.
Okay. All right. And I want you to remember something real quick. It says under section 354, right? Under section 354, we take a substituted basis. So let me pull up the Sears document and see what they say they're trying to do. Let me pull it up really quickly. Remember, section 354. I want everybody to remember that. Section 354. Don't forget that. Let's see where that is. Hold on. Section 354. Where is it at? Where is it at? Section 354. Hold on. It's going to be probably in here. Let me find it really quickly. I'm going to find it. I know it's in here. Shucks. Hold on. I'm going to find the actual document. I know I've emailed it 1,000,000 times, and some people are sick of reading it. But I want to bring it home for the people who aren't there yet, the people in the back. Okay, is this it? No, that's not it. Okay, I might have to pull it up from my online. Okay, let me just read you this while I'm looking for that. Okay, this is document 1730, page 52. It says tax result. Section 1504A of the code, of which buyer is the parent or a member. I want you to write down section 1504A and you look up what that is and you'll see what I'm talking about. All right, so let me see where we are. I cannot find this section. I don't know where. oh man, I don't know where it is. Well, if you look up document 1730, page 32, document 1730, page 32, you will find section 354 mentioned in the agreement, document 1730, page 32. It's also at the bottom of my article, my last two articles. Let's look at the legal bill and see what the lawyers were talking about. They said we're going to research the amount of go-forward net operating losses that can be generated by Sears Holdings Corp. And its subsidiaries if the emergence transaction is treated as a reorganization within the meaning of 368A1G. That sound like they're talking about what I just showed you guys? Let's go to the law book. Let's go to the book. Here we go. This is chapter 16 of a law book. It says, let me let you see this. The G reorganization and the acquisition of the bankrupt Sears. Let me read you what he said. He said, most people know that Sears went into bankruptcy in late 2018. Some people may know that a significant part of Sears was acquired in early 2019 by a corporation called New Sears, controlled by the controlling shareholder, Eddie Lampert. Let me show you this part. Few people know. Can everybody see that? Few people know that the transaction in which New Sears acquired old Sears was structured to qualify as a G reorganization. Let me make sure I make this clear, and I'm going to explain to you why we have this opportunity. We have this opportunity because few people know. If people knew that we had billions of unencumbered assets, and all we did was take those assets and move them out of bankruptcy and already paid off our debts, the stock would be $20 or $30 or $40 or $50. But this law professor said few people know this structure. That's why people online are talking crazy. This law book came out in 2019. It was updated 6 months ago, and people have this chapter. It's online floating around, and they don't understand it. Few people know. Here's the book. This book is $1,000. If anybody wants to go buy it. That's the book. They did an entire chapter on Sears. Everything I've told you is confirmed, and stuff I've told you isn't even in the book. The junior dip, the unencumbered collateral, it's not even in the book. It's not in the book. If it was in the book, the stock probably be $20, $30. People will be finding a way to purchase it. That is the challenge. Few people know. This is a copy of the small format stores that we're opening across the country. These stores make $1.8 million. 4 people run them. They're 10,000 square feet. We're not doing big stores. We're doing small stores with mattresses and appliances. Nobody's talking about all these stores opening up around the country. They're talking about the stores we closed. Here's your pro forma. Again, we got a real estate bridge of $175 million, backed by real estate worth about $1.75 billion. All right. So keep this in mind, guys. You can't have a conversation like this online in a comment section. Would everybody agree with me?
Yes.
All right. So let me show you one more document. This is the last document, then I'm going to take questions. This is the Chapter 11 plan, document 3276, page 41. Everything here you can look up for yourself. This is not Photoshop. I didn't make this up. And I'm making that point because people online say I'm Photoshopping. I want you to pull these documents yourself. The effect of the sales transaction on the debt financing. How much was the loan? Wasn't it $350 million, right, guys? Mm-hmm. All right. So we're talking about that same $350 million. Upon the sale closing, the entire $350 million of the outstanding principal amount owed under the junior dip was rolled over with the consent of the junior dip lender. So all we did was take the collateral backed by the $350 million and move it out of bankruptcy and move it over to Transform. We know that loan is paid off because they announced in March 2020 that they had no debt. So we have all those unencumbered assets. We have all the money those assets have earned, and we have all the money that Eddie Lampert has invested on our behalf. That's what we have so far. The numbers I can tell you from the court record, we have at least $100 a share at the very bottom number, and possibly a lot more. But according to the court records, I get to a minimum of $100 a share with no money coming in from retail, no money coming in from online, and no money coming in the last 3 years. We still get to $100 a share. That's pretty conservative.